Hello everyone, welcome back to the channel. Today I will talk about a stock that was requested by a subscriber and a member of the Discord group chat that has potential to more than double or even triple. This stock is Root stock, ticker symbol ROOT. This stock is down 36% since they went public, and it was even down almost 50% at one moment, and we're gonna see why. So today I will analyze the company, their financials, their competitive advantage, and see the growth potential that they currently have. If you're new to my channel, welcome. Please consider subscribing and smashing that like button since it really helps the channel out. Also have a completely free Discord group chat. The link for that is down in the description below, as well as the 4 free stocks with Webull, which you're able to get by opening an account with them and depositing $100. The link for that is the first one in the description below. I do have to say that I got attracted to the stock since it was mentioned in the group, as I think this is an industry worth looking at. As many of you may know, I'm an investor in Lemonade, which I have done multiple videos about it, and the stock has skyrocketed since then. Root is very similar to Lemonade, since both companies want to disrupt a huge and very old industry to provide better services and deals to their clients. Root is a technology insurance company that IPO'd last year, as Lemonade is a mobile-first app, meaning that you are able to do everything with only your phone through the app. You are able to get a quote, manage your policy, and everything from your phone. It is a company that is creating a potential excellent investment opportunity, as this is a high growth company. They created this company mainly because consumers have little to no control over their auto insurance. Their policies are often priced using stale demographic information that is hard or impossible for consumers to change, such as age, gender, marital status, or education. It's also an industry where historically lower risk good drivers are systematically overcharged to subsidize losses that emanate from higher risk bad drivers. It is not a secret that no matter what, us younger drivers will always pay more for our car insurance, since we are more likely to be a high risk driver since we have no history for them to prove. There are other insurance that just consider your gender or where you live to give you a quote. Here is where Root Insurance comes in and tries to revolutionize the system. They collect data using their technology and improve what insurance nowadays do, and are able to give better offers to their clients. But what do they take into consideration to give you a quote? As simply as your phone. All of us walk around and go everywhere with our phones, and we know a lot of apps such as Google Maps are tracking our movements every single minute. Well, Root is able to learn about your driving and what your behavior is while driving, if you are distracted using your phone or not, and if you drive too fast or too slow, crazy or perfectly. How do they measure if you're a safe driver or not? As easy as you first download the app, give it a try for about 2 to 4 weeks to be able to collect data, and then you choose your coverage depending on what they offer, depending on your driving experience, and then you're able to manage your policy from your phone and get support whenever you need. They use your magnetometers, accelerometers, gyroscope, GPS, calendar, clock, and behavioral elements, which I think that is excellent, since that way they are able to know how many days a week you drive and how many hours a day. I think that is very important, since for example me, that I work from home, I do not go out that much in comparison to someone that has to go to an office, but I have to pay the same amount of money for insurance as the other person. Also, behavioral driving data is the first thing we look at when considering a customer's risk. And in the case of the 10 to 15% highest risk drivers, we underwrite out these customers without considering any other variable, meaning that they first look if the person is a distracted driver or not, and how its behavior is while driving, and they actually underwrite or do not accept 10 to 15% of drivers because they are high risk drivers. Obviously, they benefit from this since their risk of cost is way lower, as their drivers are less probable to be involved in an accident. I do think this is a huge and innovative company, since they are entering into a huge market. It is $266 billion market in the US only, and is also offering very innovative technology which the bigger insurance companies do not provide. Yes, some of the other insurance companies have apps and everything, but are not able to collect data as fast and as easy as Root is currently doing. Also, Also, they are able to save money with the technology. For example, auto damage appraisers are able to write estimates from photos, which is way less expensive than a field inspection, since they do not have to go and visit the customer. Now, even though they make more emphasis in the car insurance industry, they do offer other services. They have car insurance, renters, and homeowners insurance, but they are not available nationwide. They do not offer all of these services right now. For example, if you are from Florida, they are not available. If you are from South Carolina, they offer only this one, and then if you are from Texas, they offer both car and homeowner insurance. But if you are from Utah, they do offer the 3 services. This means that they have still a lot of room to grow. As they said, now that we have more mature product informed by millions of customers' experiences, we plan to bring Root nationwide. After disciplined expansion into 30 states, we are ready to accelerate that reach. They are practically focused on their growth and accelerating it to be able to expand faster. And the technology, the data collection, is the one that will help them achieve their goal and grow faster. We collect roughly 4 terabytes of rich behavioral data on a daily basis directly from our customers. Smartphones using the magnetometer, accelerometer, gyroscope, and other powerful sensors contained in those devices. These sensors allow us to track driving patterns that are most relevant in determining a person's driving ability, such as hard braking, abrupt turning, and distracting driving. That is just impressive, since that will help them be able to improve their company, their product, and the service that they provide to their customers. Now, let's check their financials. To start, they have $224.5 million invested in fixed maturities and short-term investments, and $217 million in cash and cash equivalents. They have total assets of $838.5 million and total liabilities of $848.5 million, which obviously is not the best balance sheet ever, since they have more liabilities than assets. But we have to take into consideration that this is a high growth company. Obviously, I do expect them to increase their capital in the medium to long term with stock dilution or financial help, since they do need more money to continue doing research and growing their business. On their income statement, we can see that their revenue for the third quarter dropped about 36% from $79.6 million to $50.5 million. But in a 9-month period, their revenue has actually increased 61% year over year. Still, their net loss did improve for the third quarter from a loss of $100 million to $85.2 million, which proved that the company could be able to achieve profitability with time as the company grows, since their revenue decreased by a lot, but their net loss improved a lot. The thing is that their revenue dropped for a single reason. As they said, we are proud to say that beginning of July 1st, we transferred 70% of our premiums and related losses to reinsurance, while also gaining 25% commission on written premium to offset some of our upfront and ongoing costs. These reinsurance programs is exactly what we need to allow our equity capital to drive growth and build a deeper moat around our technological advantage, and that's what really matters. So yes, their revenue dropped, but it was because of this reinsurance contract that they made to transfer 70% of their risk to reinsurance to be able to scale faster and have larger business, being able to get more and more data from their customers and be able to scale faster their sales and marketing to grow even faster. Let me know in the comment section below if you knew anything about this company, or if you have heard about it before, or if you started a position in it. So the question is, will I invest in this company? Let me tell you something. I think this is a very innovative company with a high growth potential and a lot of room to expand even more. They have a revolutionary and innovative product and service, and as I said with Lemonade, as it is a brand new stock and a growth, money-losing company, I do expect a lot of volatility around the stock, as it happened with Lemonade at the beginning. I do plan to start a position in Root Inc. since they are disrupting a very old industry, and I think both Lemonade and Root are able to do so. But we have to take into consideration that it is a high-risk, high-reward investment, as a lot of things could happen in the short term and they could easily go bankrupt. As always, I start started a very small position, teeny tiny position in the stock, as I always do, and I'm planning to increase the position with time to be able to get a better price if we see lower prices. I'm not a financial advisor, and you should do your due diligence for this company, but I do recommend you analyze this stock very well, as Lemonade did excellent, and even if it drops, I still think it is a good investment long term. Thank you everyone for watching. Please consider subscribing and smashing that like button for the YouTube algorithm, since it really helps the channel out. Hope you enjoyed the video. Thank you and see you next time.